The federal historic tax credit is responsible for approximately 45,000 completed rehabilitation projects since its establishment in 1978, representing more than $100 billion in private investment in historically significant American buildings. It has been used to convert former factories into loft apartments, former office buildings into boutique hotels, and former schools into mixed-income housing developments in cities across every state in the country. It has also created a specific financial structure that produces boutique hotels in historic buildings, extracts the tax credit equity from those hotels within 7 years of their opening, and leaves behind either a building that has been successfully rehabilitated and is operating as a viable business, or a building that was rehabilitated as a tax credit vehicle and is now operating in a market that may or may not sustain the business model the rehabilitation projected. The historic tax credit machine is the specific mechanism this episode examines. The combination of federal tax policy, tax credit equity markets, historic preservation regulations, and boutique hotel development economics that has produced the most significant portfolio of historically rehabilitated boutique hotel properties in American history. And that has also produced the specific category of financial distress that occurs when the tax credit equity exits, the compliance period ends, and the property's operating performance is revealed to have been optimized for credit generation rather than for long-term hospitality business viability. The historic tax credit is not a bad policy. It has preserved buildings that the private market would not have preserved without the subsidy, and it has produced economic development in post-industrial neighborhoods where private capital would not have invested without the credit's risk mitigation. But understanding how it works, specifically how the credit is structured, how the equity is generated and extracted, and what the property looks like after the credit period ends, explains a specific category of boutique hotel financial distress that this channel has not previously documented in this form. Subscribe now, because the hotel you stayed at in a beautifully renovated historic building downtown may be operating on a financial model that the federal government subsidized and then exited. The Federal Historic Tax Credit, established by the Tax Reform Act of 1976 and significantly expanded by the Economic Recovery Tax Act of 1981, provides a 20% tax credit against the cost of qualified rehabilitation expenditures for certified historic structures, meaning buildings listed on the National Register of Historic Places or certified as contributing to a National Register historic district. The credit's mechanics require understanding a specific financial engineering structure. The tax credit investor, who is typically a bank or financial institution with substantial federal tax liability, provides equity to the rehabilitation project in exchange for the tax credits and the associated tax losses that the historic building rehabilitation generates. The credit investor's equity contribution effectively reduces the project's net cost by the amount of the credit, 20% of the qualified rehabilitation expenditure. The credit investor's equity is not permanent. The credit compliance period is 5 years, during which the property must remain as a qualified historic structure and the credit investor must remain as an equity partner. After the compliance period ends, the credit investor can exit its equity position through a predetermined exit mechanism, typically selling its interest to the developer or a third party at a price reflecting the remaining value of any unclaimed depreciation and operating losses. The 7-year period that this episode references reflects the full economic cycle of the tax credit transaction. The rehabilitation period, during which the credit is earned, plus the 5-year compliance period, after which the investor exit is typically executed. The boutique hotel specifically attracts historic tax credit transactions because the hotel use generates the operating revenue that makes the tax credit transaction financially viable to structure, while the historic building's character, provides the differentiation that supports the boutique hotel's premium room rate positioning in its market. The specific financial distress that the historic tax credit machine produces in boutique hotels is not the financial distress of the rehabilitation itself. The credit is designed to subsidize the rehabilitation, and it successfully does so in most cases. The financial distress occurs after the rehabilitation in the operating phase, when the boutique hotel's financial performance is revealed to have been projected on assumptions that the credit transaction structure incentivized toward optimism. The historic tax credit transactions economics create a specific alignment problem in boutique hotel development. The credit investor's return is determined by the credit's value and by the tax losses generated during the compliance period, not by the hotel's long-term operating performance. The developer's return during the rehabilitation and credit period is determined by the credit equity's contribution to the project's capital stack, not by the hotel's long-term operating performance. Both parties, the credit investor and the developer, have incentives during the transaction's structuring phase to project hotel operating performance optimistically enough to support the credit transaction's equity structure, but neither party bears the risk of operating performance underperformance during the credit period with the same urgency as a hotel operator whose entire return depends on the hotel's long-term performance. The result is a specific category of boutique hotel pro forma, whose occupancy and rate projections are calibrated to support the credit transaction structure rather than to reflect the market's demonstrated demand for a boutique hotel in the specific location at the specific rate the transaction requires. After the 7-year credit and compliance cycle ends, the tax credit equity exits and the hotel's operating performance is revealed as the primary determinant of the property's financial viability. If the operating performance matches the optimistic pro forma, the hotel is a viable business. If it doesn't, and boutique hotels in markets where the historic tax credit is most actively deployed, the post-industrial neighborhoods and secondary downtown cores where historic rehabilitation makes the most economic sense often face RevPAR constraints that the pro forma overstated. The hotel faces the same debt service coverage deterioration that case file 060 documents as the universal hotel financial failure mechanism. The geography of historic tax credit boutique hotel development maps almost precisely onto the geography of post-industrial American cities. Baltimore, Cincinnati, Cleveland, Pittsburgh, Richmond, Providence, and dozens of other cities whose historic commercial and industrial fabric provides the building inventory that the credit is designed to rehabilitate, and whose real estate markets are strong enough to support the boutique hotel development that the credit transaction structures, but not always strong enough to sustain the RevPAR levels that the operating projections assumed. The specific boutique hotel markets where historic tax credit transactions have produced the most visible operating phase challenges are the markets where the credit subsidy was most necessary to make the rehabilitation economically viable, which is to say the markets where the gap between rehabilitation cost and achievable hotel operating revenue was widest, requiring the credit's contribution to close the gap. That gap is closed during the rehabilitation phase by the credit's equity contribution. In the operating phase, after the credit equity exits, the gap is revealed as the difference between the hotel's actual RevPAR and the RevPAR that the debt structure requires. The historic tax credit machine is self-limiting in the most specific sense. The credit subsidy is necessary precisely in the markets where the hotel's long-term operating economics are most challenged. And the credit's exit at the 7-year mark reveals the challenge that the credit's presence had been managing. What the historic tax credit machine reveals in the context of this channel's 106-case archive is a specific federal policy mechanism whose design produces the real estate outcome it intends. historic building rehabilitation, while creating the operational challenge that follows from rehabilitating buildings in markets where the credit was necessary because the market alone could not justify the investment. The policy works as designed. The buildings are preserved. The boutique hotels sometimes are not. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication.